Hey everyone, meet Kevin here. Is the recession canceled, or is this the beginning of the double dip crash? Today, the media and stock market are celebrating a fall to 13.3% unemployment, which is ridiculously high, yet this has led the stock market to skyrocket and race to within 6% of all-time highs. Some companies like airlines, the mall REITs, and retail are soaring up 20% again today, leaving some of the stay-at-home favorites like Netflix and Zoom in the dust. And so the question is now, is this the time to sell? After all, how can a 5-day winning streak not be met by a crash or at least some kind of substantial pullback? Isn't all of this euphoria just more FOMO? That is, there's so much fear of missing out that the people who've been waiting on the sidelines are now diving in with full force into the stock market. And you know what? The stock market just can't go down. Well, there are two theories here. Theory number one is that the stock market is being propped up by cheap Federal Reserve stimulus money, which has already substantially increased the money supply without causing inflation, which is mind-blowing enough, and targeted programs like the Paycheck Protection Program are kind of artificially employing people, opening up stores, and are creating the appearance of a successful economy. But if customers don't come, and restaurants don't fill up, and airlines don't add new routes, we might be in for that catastrophic decline. That is, we might end up seeing that infamous double dip recession, which is what kept so many of us from investing between 2010, 11, and 12. The fear that a shadow inventory of foreclosures would come out and destroy everything again, creating even better buying opportunities. Is that double dip going to happen again this time? See, in the media today, rather than using phrases like the double dipped recession or shadow inventory of foreclosures coming out to haunt us all, we are advancing in society. We are using letters. We are using the V-shaped recovery, the rocket ship recovery, if the V wasn't clear enough, and comparing that to this theory number one, the W-shaped recovery that could drag on for years only to be pummeled down even harder by the coming inflation crisis. And when faced with high inflation, guess what the Federal Reserve tends to do? When faced with high inflation, the Federal Reserve tends to bump up interest rates, even though that makes a lot of us suffer as our asset prices plummet, just to try to get inflation back down and into the box. And guess what that does? Well, that tends to temporarily destroy real estate pricing. It hurts the stock market in the short term, which on top of an already weak market could lead to that massive foreclosure crisis that a lot of us are calling for via that longer term W-shaped recovery. Heck, it could even be an L, where we just have long-term pain, more job losses, and substantial and real discounts in the stock market. Well, that's theory number one, which many of us believe will be true. But then there's also theory number two, which about 50% of us, that is the other half of us, think is going to be true. This is what theory two sounds like. Theory two suggests that this market crash was caused by artificial means, and that horrible economic data for March, April, and some of May is to be expected. That this, along with a massive panic, a sudden shock when we locked our economy down, led to bottoms on March 23rd and April 3rd in the stock market. And since the stock market is forward-looking, the stock market has been rebounding. It's kind of been rebounding like an unevenly loaded barbell. On one side, you've got no weights, and on the other side, you got no weights because the market just crashed, and you're like, well, come on, I gotta exercise. It's been 3 months since I've exercised, all right? So now you put the barbell back on the weights, and then you go over to the one side, and you put the weights onto the recovery stocks. The stay-at-home stocks, the Activision Blizzard, the Wayfair, the Etsy, the Netflix, the Zoom, only to finally come around to the other side and put some money, aka weights in this example, onto stocks like the airlines, the mall REITs, the hotels, and Vegas stocks. Theory number one says this sort of rebalancing of the barbell is fugazi. Theory number one looks at this barbell analogy and says, no, this is all fake money. It's a balloon ready to burst, and it'll only get made worse when rates finally tick up and destroy all of the market. But theory number two, loading up the barbell, says the balloon's already burst, that this is just a return to normal. And since the stock market tends to lead the economy by 12 to 18 months, the stock market is surprisingly acting rationally, despite feeling eerily disconnected from those of us now jobless or with less income or with businesses that are struggling with fewer customers. This then begs the question, how do you protect yourself and what should we do today? Well, the number one most important thing is to look at our jobs. How stable of a job do we have and what can we do to stabilize our income going forward and hopefully increase our income? Because that's going to help establish what I call our risk threshold. Look, somebody making $20,000 per year probably shouldn't be YOLOing it with $10,000 options on Tesla. They probably also shouldn't be buying a house and probably wouldn't benefit much from buying stocks right now anyway. Alternatively, somebody with an income of over $50,000 and a job that looks stable and has upside potential with income probably had the potential of riding a stock market recovery within the last 60 days if they were buying, or has the potential of starting to invest now. Except stocks now seem quite pricey again. It's kind of like January all over again where we're kind of like, what do we do? Do we buy everything at all-time highs or do we not do anything? I guess I'll just throw it into an index fund and buy at all-time highs. And no matter which income you're in, you can't help but wonder which theory is going to be correct. And see, that's the problem. Even if you're sure that this is a V-shaped recovery and you're on team theory number 2, you're loading up the weights onto that barbell. You're like, it's good. Market's forward looking. We're on the road to recovery. I'm a long run buy and holder. I'm good. It's going to be a V. You can't help but wonder if theory 1 is going to be right. And if you've sold all your possessions and you've thrown everything into gold because you believe in theory number 1, you probably wonder, oh, holy smokes, what if the theory 2 recovery is right? And so we're each messed up with this psychology, no matter which way we look at it, of what if the other guy's right, even though we're vehemently opposed to the other side's opinions and will say anything possible to defend our own beliefs. Well, here's the path that I'm looking at right now, because I believe it's kind of in the middle. Look, over the last 90 days, I have to be upfront, I've been buying stocks like crazy. I told everyone in my course that I'd be buying stocks instead of buying real estate starting in March, even though I'm a real estate broker and real estate investor at heart. I drew down on credit lines and I ended up refinancing 4 properties to have more cash available to buy in April. I ended up refinancing on March 6th, locking in some of the lowest rates possible on investment properties, increasing my cash available in April, and plowing into the market. I was able to buy a bunch of cheap recovery stocks. But now things are different. Now I'm actually taking more of this in the middle approach where I'm looking at, all right, well, now I really only want to buy stocks if I really see an opportunity where things have fallen. And I think today they're going to have to fall quite a bit for me to really feel excited again. So I'm not quite theory 1, and I'm also not quite theory 2. I feel in the middle. And instead what I want to do with my income now is preserve, I hate to say this word, but preserve cash. Except many of you know that when I say preserve cash, what I mean is I'm paying off my credit lines. See, credit lines are kind of like credit cards, except they're way cheaper, right? Credit lines cost me somewhere around 4 to 5% interest. And so I'm gonna take my extra income and create a new war chest by paying off my credit lines and paying off any margin loans that I have on stocks. So that way, when and if there's an opportunity that comes in stocks because theory 1 is correct, I'm not going to sell any of my stocks today, but if stocks go on sale again, I'll be able to draw on those lines again, and I'll be able to buy. Vice versa, by paying off my lines and sort of building a war chest, I'll be able to do what I've done for the last over decade now, and that's building up cash and waiting to buy good deals in real estate below market value. Now, I will be clear. The only way I buy real estate below market value right now is if I could buy real estate a good 30% below market value, because that theory number 1 and theory number 2 mix does say, Kevin, either way you look at it, you really want to protect yourself right now. And that's what we talk about in my programs, right? My programs are right next to the links for you to get 2 free stocks with Webull when you deposit $100 and life insurance. Get life insurance. They emailed me today and they're like, Kevin, make sure you tell people you could sign up for life insurance in as little as 5 minutes. I guess they didn't like that I had been saying you could sign up for life insurance within like 3 or 4 minutes, even though a lot of you can do that. They want me to say you can sign up in as little as 5 minutes. So in as little as 5 minutes, click the link and you could have life insurance down below, all right? Okay, there, I'm in compliance now. Anyway, let me just be clear. I am not theory 1 and I'm not theory 2. I do want to know what your opinions are. And look, if stocks fall again, I realize that there's nothing worse than SOMO. SOMO is my new kind of way of playing a twist on FOMO. That is, FOMO is the fear of missing out, while SOMO is the sadness of having missed out. And I don't like SOMO. I think SOMO is worse than FOMO. And so if you're confused, here's the bottom line. If stocks decline next week, I'm going shopping with the extra cash that I have or money I have available on lines, which I use as my emergency fund. If stocks keep going up next week, I'm done. I'm not buying anything anymore, but I'm also not going to sell. The big reason I'm not going to sell anything right now, like the Simon Property Group, which I recommended to y'all, or for so long we're talking about Delta and Carnival, which are right up there with the Simon Property Group as a recovery stocks, or the other stocks that we've been buying, like whether they're Tesla, Amazon. You could go to metkevin.com/index and see all of the stocks that I buy. That's the easiest way to do it. Well then, hey, you know what? There's no reason to buy anything if it's skyrocketing up anymore. Might it be higher next year? Sure, it might be. But the bottom line is, I don't want to sell anything and then have to pay big fat taxes, because in California, I lose 50% of my money when I go to sell in the short term. Thanks to California and federal state combined income taxes, I get screwed. And so 50% on gains in taxes kind of sucks. So I personally don't like taxes, and you should not like taxes either. So I guess this means what I'm really going to do is I'm going to have to leave what I call lockdown dungeon and actually get back into real estate, while at the same time being conservative, paying off credit lines, and building a new war chest to be prepared for what's to come. Because right now I'm just not seeing screaming opportunities. And if there are screaming opportunities in real estate, I'm going to jump on them. And so I think in the meantime, the most important thing for you to consider is A, how can you increase your income? B, how can you stabilize your income? C, how can you increase the amount of flows of income you have? Did you take this lockdown period to create a side hustle? Did you create a 3D scanning business? Are you creating an additional source of income for yourself? So that way you're able to create a war chest faster and jump on opportunities when they come up. You know, whether that's starting in a real estate fund or starting by buying your own house, or maybe it's starting it with an index fund. Who cares how you start? There's no question that in America, you have to start and think about investing. Otherwise, you're just gonna get left behind. But I really wanna know, what do you all think? Beneath this news of the unemployment data, is there a secret demon waiting to come out via theory number 1? Or is theory number 2 going to keep being right? And is it wrong to stay in the middle at a time like this and only make a move when there's a good opportunity that presents itself again? Let me know what you think in the comments down below. Thank you so much for watching. Consider subscribing, and folks, we will see you next time.